Good evening to everyone. I hope you are all well and like always ready to start the course of today. I welcome you to all to yet another session of SBR. We are meeting for fourth time and mainly taking a start of the complex aspects of the course of today. In the past two sessions, we have been discussing all the basics of consolidation, and we found a bit of time to start off with the complex aspects the last week. But mainly, we will have to invest the time onto it today. So I request to all of you to stay a lot attentive and concentrate as hard as you can. Since lots of complex aspects, newish aspects that you never have seen in the past will expect to come to your way. Obviously, what we have done in the past 2 weeks, if you are keeping the knowledge of it, it's going to be a greater help since there was a lot of importance of that. So I have spent the first 2 sessions of the SBR in revising the basics. There are tons of things you people have been able to refresh in regards to consolidation, goodwill, reserves, NCI, net assets note, fair value adjustments, intra-group cancellations, types of consideration, share exchange, loan stocks exchange consideration, deferred consideration, basic steps of consolidation, mid-tier acquisition, associates in the recent times, the way we have to treat them off into a statement of profit loss and into SOFP. All the knowledge that has been given to you was missing, but I have taken that step to refresh you all with. I hope at your side, you are taking it as serious as I want you to be. Let me take you to the board just to show to all of you a little part that we have talked about the last week so that we can get back into a same momentum to spend the whole next 3 hours on learning. A lot of constructive discussion is expecting. So let me connect to chapter 2 and the board on which we already have got those pre-written summary notes. And this is the chapter from which we will be learning the 2 of the things from the STIP acquisitions. I told you the last week we will be doing it first. Disposal of aspects of subsidiary will be doing it after. And even the STIP acquisitions were started. I can try and give you a bit of recap of it quickly so that we can get back into a same flow as we were on the last week. So what makes the acquisition to say it as STIP acquisition? What makes the acquisition to say STIP acquisition? The acquisition that has been achieved into steps is called a STIP acquisition. The parent has acquired its interest into subsidiary into various steps, into various stages. It's called a STIP acquisition. Number of cases to look down under: a case where you already own a subsidiary, but by taking an extra step of investment, have started gaining it a bit more. It was originally an associate, but by taking a second step of investment has become a subsidiary. It was originally a simple investment, but by taking a second step of investment has become a subsidiary. So in all those 3 cases, the one thing is common: by taking the second steps of investment, they have been controlling the subsidiary today. So they haven't achieved this 90% in a one-go step. They haven't achieved that 70% in a one-go step. They haven't achieved that 70% in a one-go step, rather in 2 are called to be the examples of STIP acquisitions. These 2 cases I told you will be of pretty much the same kind. This one is the odd one out that I did start off with the explanation of that even the last week. What makes the 2 of these cases to be similar? This thing: by taking a second step of investment, the control was established. But before taking the second step, it was something else, associate, a simple investment. After taking a second step of investment, the control was established and the subsidiary was then acquired. We will look into it, all coming to your way. With a lot of patience, we will spend time on each case. But let's be on to the case where we were the last time, and explanation of that case was over kind of, but definitely I will take the next 5 minutes to give you a good recap of, and we'll do a one question on that. This way I have been able to pen down the notes for all of the cases for each of the statement, profit and loss, statement of financial position. A title of the case has to be on top. This is the case that we've opted where this company was already been held by 60%. And by taking a second step of investment by 30%, they have started controlling this company by 90. It was by 60, but has become 90. So I was trying to emphasize on to consolidate normally, since it does not really matter. You hold the company by 60%. Now you have started holding it by 90%. As long as it is more than 50%, one has to simply consolidate. That does not make any difference into the steps of consolidation. So consolidate normally and normally, and we should be recalling that normal way of consolidation from our basics, the steps of consolidation, the note of net assets, the goodwill reserves, NCI calculation. Yes, goodwill was once worked on that day. This is the day when the control was achieved for the very first time, and the goodwill had been worked at. Later will not change, because the goodwill does not remeasure. Goodwill could only have an effect of one thing. That effect is the effect of impairment. But that step acquisition has no effect onto it. Originally worked, later will not change. While the NCI, we definitely have to recognize based on the percentage at the year end after step, which means at 10%. So this is what I will come to explain to all of you. How will I be able to achieve this? But for profit and loss, I was also discussing it. Look, if the step was taken midway, then you must have to calculate the NCL by considering the months before and months after. The best example of that was this, where I did explain to you the day the step was taken was 31st of August. In the first 8 months of the year, they had been having an NCI by 40%, while in the last 4 months of the year, they have been having an NCI by 10%. So to bring this out into computation, I had been able to work this computation in 2 blocks. The block before step, the block after step. The yellow one is before, the green one is after. So if you look into the block before step, you could see me using the NCI by 40% for 8 odd months. But in the block after 2 step, you could see me using the NCI by 10% of 4 months. While the same profit after tax or subsidiary we have to take. This is what we have to do when the step has been taken midway, and you have to calculate the NCI based on the months those are before and after. And then the highlight of this case, if you ask to me, I will say equity adjustment. Why is this adjustment to be passed? Why is this being called it to be as equity adjustment? See, before taking a step of 30%, this is by how far the group has been having an interest and NCI respectively. When the group has been able to acquire extra 30% interest, the NCI will surrender 30% of its interest towards group. So this arrow clearly indicates a transfer being made by one owner to another owner. So to reflect this transfer, one has to pass an adjustment directly into equity, because this is the transaction that's been happening in between the owners. So you cannot expect to record the same thing into profit and loss. That's not with customers, suppliers, or lenders. This transaction has been happening in between the two of the owners. So the effect of that has to be made directly into equity. So it is called as passing the adjustment into the equity adjustment. Well, the way this needs to be passed is a 2-line pro forma. the payment of consideration to acquire that extra step, which the question will tell us about most of the times, cash paid, consideration paid. Less the transfer from NCR, this transfer. So this has got a working. Let me take the first example from which I will be taking the facts to really work this transfer for you. And then whatever the figure we will get might be a positive effect onto equity or might be a negative one. Totally depends on the facts. This is where exactly we've left the course. Could not practice a question onto it, but yes, we will do it and have been able to recap a little. Now we can get ourselves into that example to see how will this to be worked. Illustrative example 2.4. Let's be on. Mind you, every case that we are discussing, you at your side have to concentrate on understanding the reasoning behind that point, not just try to grab it. Because if this was the case, I would have shared this file to you. Because you'll not be asked to reproduce these points, you will be asked to rather apply these points. So when you actually know the assents, then you'll be able to apply. So I have been explaining to you of, while when I say that consolidate, normally I have given you the whole reasoning behind why. When I'm explaining you that the goodwill is to be worked, originally data will not change. I'm giving you the whole reasoning of that why. The goodwill is worked the time the company is acquired. Subsequently, it does not change. Regardless of the fact how many steps they have taken. Goodwill is the date of acquisition thing. It is worth the time the company is acquired. Later does not have an effect of anything except impairment. Well, equity adjustment, I did tell you that why is there a need to recognize and how to is a bit of a calculation. So on the 1st of Jan 2090, acquired 75% of BOY for 300 million. So 75% is already a subsidiary. In the very first attempt, they have acquired the interest into a subsidiary. The fair value of the identifiable net assets of BOY on that date of acquisition was 180. So now they're providing us with the value of net assets of subsidiary. Do read every bit of it. No matter, I'm doing these efforts for you, and I'm not even asking you to note it down, since my concern is more to explain it, and you should rather be there sitting, concentrating it hard as you can, and not to write it. Because if you will write it, you will be concentrating it on writing, and you will not be concentrating on what's actually going on. And later you will be finding an issue. But still, you can do it because by anyhow you get the recording of each lecture. So even if you have missed on some of the live explanations that I was talking about and you have not been able to pick, you will be able to review the same from the recordings. But still in the course, in the live course, I would prefer you to focus more on whatever is going on onto the screen. Because once you will be able to learn, then you might not even be needing to have a board work, which you definitely will get an access to it, as I always share the board work. Whatever I do, you get the copy of it. But once you have learned, you will get the copy of what I am doing it onto screen. So that's no loss. Loss is what you concentrate on preparing your notes and not really understanding the essence of the topic. That's totally a disaster. You concentrating it hard on writing, but not concentrating it on what I am suggesting, what I am explaining, and just concentrating in preparing your notes. So preferably concentrate, sit there in a relaxed manner, just concentrate what's going on onto the screen, but by not being worried for the resources, because by anyhow you get the resource of everything that I do in a PDF form, in the recording form, should not be a big worry. Yes, I was going to read up this question. So that's what I'm telling you. You have to read this question as if you are actually going to solve this question. So you have to involve yourself fully into it, word by word, read it with the way that I am. The fair value of the NCI was 80 million. Typical stuff is provided. They're providing us with the value of net assets. They're providing us with the value of NCI. They are suggesting which policy of NCI do they adopt. So the first paragraph has got nothing. No step here. Basic stuff. Cost of investment given, first line. Value of net assets given, second line. NCI given, third line. That's it. Finally, a year after almost, no, exactly a year after, what is happening? Further 5%. That is where the step acquisition has come into play. Consideration is given. I told you the consideration will always be given. 5 million 5% interest they have acquired by paying $24 million. The profits being made by subsidiary over the year by 20 million. Therefore, the carrying amount of the net assets now have become 200. See, 180 had been the value, which has gone up to where? 200. 180 has gone up to where? 200. 180 has gone up to 200. What is a change that you can observe? And that is what we call it as post-acquisition reserve. Remember, we always in the past had been preparing the column of net assets, acquisition day column, reporting day column. So acquisition day 180, reporting day 200. So the change that we find into it, what do we call it as? Post-acquisition profit. Which right now they also have provided, which will not be provided all the time. You always have the way to find this out. That way is this, comparing the profits of that time with the profits of today, or net assets of that time with the net assets of today. So if you look into this question, it has only the one thing newly coming in, that step acquisition. Otherwise, the same typical content as we have been dealing with into basic questions we find. Cost of investment is given, NCI given, value of net assets are given. They're providing us with all the typical stuff that one of the question of consolidation has to have, except this one extra step. This is what we have to see, what sort of difference it can make into the stuff that we have been doing it into the past two courses: goodwill calculation, reserves calculation, NCI calculation. What sort of difference this extra 5% step will bring in? That's the whole concern of the topic of today. So I'll start off by very formally analyzing it. Illustrative example 2.4. The year when it starts, 1st of January 2009, and it ends on 31st of December 2009. Starts on 1st of January, ends on December 9. This is the day when this company was acquired. They have acquired 75% of an interest. 75% acquired, which by the time the year ends has gone up to 80%. Is it or not? How come? Because that is the day they have taken a 5% step. No, not 85% acquired. 80% is total. What they have acquired, standing it onto that date, 5%. So that takes the whole interest up to 80%. It was already a subsidiary, now have become a little more controlled subsidiary, extra controlled subsidiary. Were into the same case or not? Did they acquire this 80% in a one go step? No, in two step acquisition. This is the day I have to stand on, firstly, and work what? Goodwill. Because goodwill is going to be worked the day the company was acquired. That day is obviously this day. So I start off with cost of acquisition, which is always the case, cost of investment, and this will be topped up by the amount of NCI. This arrow clearly indicates that this is the day standing on I'm calculating the goodwill. Now, at this point, imagine you do not know the calculation of goodwill. So problem will be where? In the topic of step acquisition or in the basics of consolidation? Which area you should be blaming? Definitely the basics, because we are trying to understand the effects of step acquisition on the goodwill calculation. So if you in the first place do not know the goodwill or the steps involved in computation, or two types of goodwill, full, partial, what is the difference of two, then The problem will be in the topic of basics, not in the topic of step acquisition. And this is where actually I have prepared you all for in the past 2 sessions. That will enable you to now concentrate more on the topic of step acquisition, not on the goodwill calculation, because this is something that you have been having like onto your fingertips all the time. But you were not in the same position 2 sessions ago when I started the SBR course. I hope you're understanding what I'm talking about. The cost of investment, 300. You have to fill it off 300 into it. NCI fair value is given. What is it? 180. So as given, copying and pasting it. Minus the value of net assets. 180. We've been able to work the goodwill. Now this goodwill we have worked standing it onto which day I can still write it, 1st of Jan 2009. This is the standing on we have been able to work the goodwill. Okay, let's leave the goodwill to its place before we will go down to the step acquisition and we'll see if we have to make any effects over to it or not. Let's go to calculate the NCI next to it. NCI will start off with its fair value, with the fair value of that is given to us. What is given to us? The fair value of it is $80. And this is what I will be able to top this up by the NCI share of subsidiaries retained earning. Right now, the name of the subsidiary is BOY. So B's retained earnings. Is this the way we work the NCI on its basis? What is the original NCI? 25% of the profit that they have made since then, which is $20. This $20 was given to us, but even if it was not given, I told you how did I get this $20 million? Is this the way the NCI is worked basically? Yes, it is that way. Again, I will repeat my words. If you do not know this basic NCI calculation, how will you be able to see the effects of step acquisition onto it if you do not know in the first place how to find the basic balance of NCI? This is where I have prepared you for in the past 2 sessions. Basic computation of NCI, basic computation of goodwill, so that today we can see the effects of step acquisition over to those, which had not been the case when in the first course we've started off the SBR. So at your side, hopefully you're also keeping the basics along so that in the live course also, it will be helping you. Okay, let's leave even the NCI to its place. As if the question does not have step acquisition going on, I have been able to work the basic balance of goodwill, the basic balance of NCI. But let's go to take the step acquisition which you have just taken it by the time the year ends. So before taking a step, and after, by how far they are taking a step, 5% step, before 5% acquisition, and after 5% acquisition, I'm taking you towards that step, the equity adjustment. So by how far the group has been holding this company by? Cost of investment 300. Where is the 300? Cost of investment, we have taken it from there on the very first line. T acquired 75% of bought for 300 million. That's the cost of investment. Yeah, I've taken the 300. So you probably have missed out a few of the facts. Okay. So before 5% of the interest, the group has been holding this company by 75% and NCI had been holding it by 25%. But the situation is now what? The group will start holding this company by 80 and NCI will start holding it by 20. So what actually is happening? The NCI, who makes the transfer of 5% of its interest towards NCI. And to reflect this transfer, one has to pass on adjustment directly into equity because this has been the transfer being made by one owner to another. To reflect this out, the adjustment needs to be passed directly into equity. How to see this way? Fair value of the consideration paid. Why paid? Because we are buying the extra interest. So payment has to be a case. In the disposal transaction, when we will do later on, I will change this word to fair value of the consideration received. Right now, we are acquiring the extra interest. So payment will be involved. And that payment will be given to us. What had been given to us? T acquired further 5% by 24 million. Transfer from NCI. Now, this is going to be a bit of a calculation. Transfer from NCI is going to be a calculation. Let's see how to calculate it. Transfer. See, the wordings that I am using are giving us this kind of impression that it has been the transfer, that I do not have to make it to NCI, rather from NCI, transfer from NCI. You also can see the whole arrow, the flow of transfer. Okay. So NCI has to transfer 5 out of 25. 5 out of 25. So the first thing that I'm going to use is going to be a fraction of 5 out of 25. And but to which figure I should go and multiply this to? Definitely the figure of NCI. Because it's NCI who has to transfer 5 out of 25. So in the end, I should need to multiply this fraction to NCI balance. And that balance, we have it with us as 85. Let's go to multiply it. This balance, we've taken it not from the question, rather from our own working. This is the value of NCI originally at which it was recognized at before step. And now I am going to make a transfer of 5% out of it, but will not just take a 5% of it because the NCI itself is 25%. So if I'm going to withdraw 5 out of this box, it will be 5 by 25, not just 5%. It will be a $17. And the figure that we have got has to be 3 plus 4, 7. Will that be an addition to equity or will that be a deduction? Can be sensed out, not a big deal, but you have probably seen for the very first time this step has been worked. That's how the way this step has to be worked. Consideration will be given to us. This we need to work. And to work this out, what needs to be worked primarily? The basic balance of NCI, because this is the balance from where you have to make a transfer. So if you can't work this balance, you can't make a transfer even from. These are the basics of consolidation. See how these basics are embedded, because the day the basic start the same moment you start to complex aspects. This has the way the basics will always be attached within your complex aspects. You can't work the basic balance. You won't be able to make a transfer out of it. This 85 one has to work it onto the way first. Now you use proportion method over here. You will use fair method. You are flexible onto that. You know how to use both the methods. Will that be an addition to equity or deduction? We can sense it out. This is what we have paid. And this is what we have acquired, claimed. So we kind of have paid a little extra and we have claimed less. So looks to me we are making a loss out of this transaction. Extra payment has been made. This is what we've been able to claim and have paid extra. I also can go and record the double entry for that, just to prove it. The nature of balance has turned out to be a debit one or a credit one. This is a payment by 24. This is a debit of NCI by 17. And see, the balancing figure is on the debit side. The balancing figure is on the side of the debit, which itself is suggesting that this will be a deduction from equity. This will be a deduction. I also can write it over here. This will be a deduction against other components of equity, not against retained earnings, against the other components of equity. Yeah, if you do not have any reserve other than this, then you can go to debit this into the retained earnings account. but primarily it has to go into other components of equity. Credit the bank, debit the NCI. The balance of bank is something that is normally adjusted into questions. I would rather say always adjusted. While this, I already have told you, will have to debit to other components of equity, you will go to deduct. But where this has to go in, let's go back to NCI note and go to subtract the 17 from, because that's what we are making a transfer out of it. So one has to subtract it. And the double entry suggests what? Debit. NCI is a credit balance. So if in that double entry, I have been debiting the NCI, it means it definitely have to subtract. This is the adjustment as a result of step acquisition. We have been able to bring it into the calculation of NCI. Transfer to words group. You can once again write this figure 5 by 25 of the, what was the post equation? It was 85. So what did we get in the end? What did we get in the end? 68. That's getting into a statement of financial position. The updated balance of NCI will go into statement of financial position of the group. Try to analyze. Actually, this figure was 25%. Original NCI was 25%, was it? I've just been able to take 5% out of it. It means what's getting into the statement right now is 20%. And that is what I was wanting it. Remember this point? NCI is to be recognized based on the percentage at year end after step. So what is the after step NCI? This is the NCI after step. What is the NCI? 20. So I have made it possible. This is the amount that's getting into a statement of financial position, because that's the NCI after the step. So when I was making that point, I was using the word calculated. I was rather using the word recognized. So primarily we have to work the NCI originally, and then we will have to try and pass on the adjustment, which will bring the NCI down to the situation after step. My objective is to recognize, but the way that objective one has to meet, you have seen that way. Originally, you have to work first, then make the effect into, so that the residual you are left up with is the one that's after step. This is getting into a statement of financial position, and by a process, we have been able to achieve it out, not just by calculating it at 20%. Have you realized? So the number of points that I was making it there, I'm covering it all, that NCI has to be recognized based on the percentage after step. So that is what I have been able to achieve it or not. What is the NCI after step? 20. That is what I have been able to exactly achieve it for. Originally 25, have just taken the effect of 5% out. So the remaining that I am left up with is the NCI that's after step, 20%, getting into the statement. This is getting into a statement also will hit the other components of equity by a deduction sign. While the goodwill originally being worked will have no alteration coming into it. Full and final will get into a statement of financial position, provided there is no impairment, which obviously in that question we do not have. So whatever the balance we see, even we see the same, standing it onto the date of reporting. Goodwill originally calculated remains unchanged. I proved it. All the points you had seen me writing it in this one question, been able to apply. Do you see any effect of step acquisition on goodwill calculation? No. Do you see the effect of step acquisition on NCI? Yes. But the way that effect has to be made is not just to start multiplying NCI with 20%, work the normal answer, and then take the effect of 5% out of it, so that the final balance that we will get is the balance of NCI after step. and follow the way the calculation is being performed, 5 by 25 of 85. This 85 exactly, we have taken it from here. So you do not know how to work it, you won't be able to calculate it, as simple as that. And that's the equity adjustment. Pretty much ends up this discussion of the first case. We are getting into a topic that is a complex one, complex in a way that it's a newish topic. Technically, it may have not been as complicated that you may have been thinking of. Complex, the word was used in the context of that's a new topic. But it's not that it's going to bring a lot of complications that are difficult to handle, or there are too many adjustments coming to our way that you will find yourself into a difficult situation. Hardly few effects. As you can see in this case, what sort of effects you have seen in? Just a little effect on NCI calculation and one new calculation, equity adjustment, that we do not usually work in basics of consolidation. Otherwise, consolidation, I have been telling you, you have to do it normally. Same steps of consolidation: net assets note, reserves calculation, adding and subtracting asset liability, same, everything same, minor effects. There is another question to look at. If you look into the solution of that, they probably have done the same, and the same way even by goodwill is 200, original NCI is 85, but by the effect of that step being taken out, what's getting into the statement is 68. This is the equity adjustment, which they also are suggesting to reduce it from equity, not to add it. And that's the double entry, which I also have been adjusted for all of you. The little explanations being done on the way. You can look into it by your side when you revise. It's in fact the same explanation when I talk about all the stuff in air. It's actually being written somewhere in the same way, in lines. Another question for us to revise this case before we get into the next case a little while after. Learning example 2.4. Calculate the goodwill arising on the date of acquisition and what accounting entries are required to it on the acquisition or at the end of the year. So at the start of the year, I acquired 70% of P for $350 million, already a subsidiary. The fair value of the identifiable net assets of P on that day was 110. The fair value of the NCI was 138. Everything is given. Let's redo the same. At the end of the year, I acquired the further 10% of P for 55 million. So 57, 10, when I'm going to add into 70, it takes the whole interest up to 80%. Consideration is given 55. P has made the profit of 20 over the year. Therefore, the carrying amount of the assets of the POP is 130 at the year end, which is something that once again you can notice 110 has gone up to 130. So the change that you have found, or the change that you have spotted, is in fact what the post-acquisition profits. So this question has got nothing new, but I need to work this question smoothly for one more time, so that when we become confident or comfortable with this case, I will take you into the next one right afterwards. So this question, just a practice to bring a little bit of more comfort and peace. Learning example 2.4. So when the year starts, and when the year ends, 70% is what they have been holding this company by, while the year ends, they have been holding this company by 10% extra. So this company has gone up to 80% just because they just have acquired the 10% of the interest. 10% has just been acquired. It was a subsidiary. It will still be a subsidiary. Now, this is the day we have to stand on and calculate the goodwill. And the way the goodwill is to compute takes the cost of investment on the first. We top it up by the amount of NCI. and subtracting the effect of the fair value of the net assets. I'm just working this answer by following the same path, the path that has been given to you in the previous question. The fair value of NCI has to be given. What is it? At the start of the year, I acquired 70% of POP for 350 million. 350. The fair value of the NCI is given into the last most line 138. And the value of the net assets of 110. That's goodwill for us. 350 plus 138. 350 plus 138 minus the same from that. The figure has to be 378. 378. This is the goodwill that we've been able to work starting it the year with at the year start, which in fact is the date of acquisition also. Okay. On the next, we'll work the NCI, and we'll be working the NCI the same way as the goodwill being worked on the up. Basic NCI, I mean to say, before we can try to bring a little bit of effects into the basic NCI starts off with its fair value, which in the question that they're providing us to. What is it? 138. The benefit of also revising those things in the past, that today we do not have to go a little slowly on few of the computations that we are comfortable with. Like if I'm working the basic amount of NCI, then you must have been having this feel that I know what's going on. I don't have to go slowly on working the NCI balance. I can be slow on working the effects of step acquisition onto NCI, but not working the basic balance of NCI. Same is applicable to goodwill, that these three steps for about 15 to 20 times in the past 2 sessions we had worked the goodwill. So I don't believe still someone in the course not being aware of these basic 3 steps of goodwill calculation. Same is applicable to NCI basic 2 points. At least on that we can be quick on, and you will be feeling it like that. Okay, we know this, what's going on. The name of the subsidiary is POP, so I should write the word P's retained earnings. The rate at which 30% is to be the original amount and multiply it by with the post-option amount, which is 20. So that's what we have got originally. Needs to make an effect of step acquisition into it. So I'll do the same explanation one more time before taking the step of 10%, before 10% step acquisition, and after 10% step acquisition. The group has been holding this company by 70. NCI has been holding it by 30. What happened later on? The group has started holding it by 80. NCI has started holding it by a little less, just because of the same step transfer being made by one of the owner to another, and the effect of that has to be made directly into equity. That is why it's not a profit and loss thing that one has to think of recording there. It's rather in between the two of the owners. So one has to directly adjust the equity with this, owner's equity with this. So how to pass on this basic little adjustment, fair value of the consideration paid? So I'm even calling this adjustment to be as basic little because we don't have lots of steps into calculating this. It's hardly a 2-step pro forma. Fair value of consideration paid minus the transfer from NCI. Transfer from NCI. So what has been paid can just be copied. It's about 55. So when I'm coming to subtract 55, I need to work the transfer. This time the NCI itself is by 30%. So when the NCI will make a transfer of 10 out of it, the working will be performed by taking the 10 by 30 of the NCI, which in this case, we have worked it to be as 144. So basic amount, we should have to have it with us before we can think of passing the transfer adjustment. 144 multiplied by 10 divided by 30, the figure turns out to be 48. That is 7. Will that be an addition to equity or subtraction? We can pass the double entry down below for us to look in. So I'll have to credit the bank just because they have paid about 55. One has to debit the NCI with the amount of 48. And see, the balancing figure is once again on the side of the debit, and luckily the same figure as we have got in the previous question. This is what they have been paying, and this is what they had been claiming. Looks to me they have made a bit of loss out of it, which in the other components of equity will be a reduction. What do we call this thing as? Equity adjustment. Okay, so this will go into equity. Fine, by a deduction. Balance of bank, I'm telling you, is always adjusted. The one thing that needs to be recorded up there is the transfer effect of NCI out of it. Transfer to the group. 96, I believe. 48, yeah. So once again, you can analyze. This figure was actually about 30%. But when I've taken the 10% out of it, what did I get in the end? Which is becoming a part of the statement of financial position. That is the NCI right after the step 20, and I have been able to prove it. This is going to be recognized into a statement of financial position after step $96, which represents 20% of the NCI's share. So with the way this needs to be achieved, and that way you already have seen me by applying it for 2 times. While the goodwill, obviously, once again, has not been impaired in the whole of that past 1 year. So even by the time the year end, it will be the same as above. Will be the same as above. Although this case by discussion, we have finished it the last time. But still today, when I started the course, I gave you the whole recap of it. And by spending a good amount of time, finally, after 45 minutes of explanation, this case has ended. 2 of those questions were to be performed, which I have been able to perform. One was the illustration. The second one was the learning example. We are pretty much done by and hoping to get into the next case in about next 1 minute. This way, on each case, we have to spend time. On average, 45 to 40 minutes on each case with respective questions to work. It takes a bit of time. And by the time we spend time on these questions, you get to learn it. Okay. Fine. All the points that I have made been applied. Goodwill will have to be worked at the time of first time gaining the control, which was that date. Later will not change. No matter how many steps of acquisition we've taken it later on, does not remeasure. Impairment could possibly have an effect onto it, but which was not happening in the past and also in this question. Yeah, NCI one has to work. First of all, normally, and then make the effect of transfer out from, so that the residual sum that we have got is in fact the NCI after step. The same transfer one has to offset with the payment of consideration to pass on an adjustment directly into equity, since it is the transfer being made by one of an owner to others. So to make an effect of that, the adjustment was directly needing to be passed into equity, which is what we have. Is it? While consolidation, I'm telling you, will have no effect of this, regardless of the fact they hold the company by 90, 80, 60, 75, as long as they control the consolidation procedure has to be applied just the normal way. While this point was something else, and to understand this point, I already have been able to explain by making one example the last week itself, which I was also trying to recap the same in the start of the course. By all of its aspects, this case has properly been scanned out. Nothing being left you need to learn further from. I'm sure you are having a feeling at your side that I'm okay with this case before getting into the next one, because next one is totally different. from the one we are working. And these summary points, the way I have been able to organize, will surely be helping you out in reading the few words from those summaries. And if you are logically sound, then obviously that's the best. Rather, you should try to cram it, should not be there. Okay, so enough of a time being spent on case one. Let's take a shift towards the case number two. What I am going to do over will pretty much be the same in third. So real investment of time has to be there on case two. This will just be an easy task afterwards. So let me bring up the page number in front on which we have case two being defined, first of all, and that page is this one. Okay, step acquisitions. This is the topic we're into. The case that now we did opt for is the one in which it was an associate originally, but by taking a second step of investment has become what? A subsidiary. The same example, I'm taking it, the one that I have used it in intro, 30 to 40. Is it? Yes, it is 30 to 40. Okay. And likewise, 2 pages. The one page is for the statement of financial position. The second one is for statement of profit and loss. First of all, as far as the statement of financial position perspective is concerned, while consolidating, what will be the effect of this onto consolidation? After taking a step of 40%, this company has now been controlled. It now has become a subsidiary. Therefore, we should have to start consolidating. Because by the time the year ends, reporting day standing on, we will be having a control. So with that control, one has to consolidate. Normally, that is what I have been able to write it into start. They had been having a control over to it, and that makes me to say to consolidate normally. But when we go on to the side of statement of profit and loss, we can expect to find a little bit of flexibility. What if the step was taken midway, mid-year acquisition? Then for part of the year, I must have to record this company to be an associate. For the other part, I have to record this company to be as a subsidiary. I've said it. Part of the year, associate. Part of the year, subsidiary. For suppose if the step was taken in 5th month, then for first 5 months, I will be treating that company to be an associate. And for the rest of 7 months, I will be consolidating. And we know very well how to consolidate the subsidiary in the case of mid-year, prorating all the components of S into 7 months before combining it into parent. The same logic will become applicable. But this is something you can't do for statement of financial. So there you had not seen me talking about anything like this. So even if in subsidiary, in statement of financial position, the mid-year acquisition is happening, but you can't be treating the assets and the liabilities to be part way through. You have to just consolidate, because by standing it onto the radar reporting, you are having a control. So that makes me to say to consolidate only. But profit and loss is the statement where for part of the year, we will be treating that company to be an associate, and for the other part, consolidation. That is what the first thing I have been able to write. Now you will read it out. You will be making the same sense out of it. Associate is recognized under the equity method of IS 28 till the date of step taken. That can be 4 months, that can be 2 months, that can be 5 months, that can be 6 months, depending upon the day the step is taken, the number of months we have to count. And for that number of months, we have to consider that company to be an associate under the equity method of IS 28. And this, I believe, from the last week of explanation, you know, you should know. As I've explained that to you the last week, equity method of IS 28, which is not the topic of today. The topic of today is to deal with the step acquisition. So on the way, if I have said it, you have to have the whole story to be made in your mind. Okay, what is the equity method of IS 28? The last week, the lecturer was explaining and was so much concerned about learning it. The reason was this, because even in the complex aspects, this equity method of IAS 28, to have the knowledge of that, very essential. Now you can see why I was so concerned about revising the associates the last week even. So associate needs to be recognized till that point where they are taking a second step. That can be any number of months, and then consolidate as from that date. So in the picture before associate, in a picture after consolidation. Only the question will tell how many months of consolidation, how many months of associate. But that explanation, whatever I'm having it now, is not valid to be talked about in regards to statement of financial position. Statement of financial position will only be consolidated as the reason of reporting day control. That discussion is only valid to be talked about with regards to statement of profit and loss. 6 months of consolidation, 6 months of associate. I'm just assuming 6 months, 6 months. So we at our own level needs to be aware of the equity method of IAS 28. We at ourselves needs to be aware of the consolidation procedure, mid-year acquisition, that you people have seen me discussing it into past, prorating the months. Okay. So first point, I guess, is clear. SOFP needs to be consolidated normally. May it be a normal case, may it be a mid-year case, one has to definitely consolidate the statement of financial position because of the reporting day control. But profit and loss is not consolidated with reference to the reporting day control. Profit and loss is consolidated with reference to the months of control in that period, not the reporting day control only. So months of consolidation, months of associate. In the picture before associate, in a picture after consolidation. Okay, let's go to talk about the goodwill. So goodwill, before we were like that, look, you do not have to bring any change to the goodwill calculation. Now, finally, we are going to make an effect into goodwill calculation. So this time, interestingly, the goodwill will be calculated by using both the steps of acquisition. Both means because we have 2 steps and we will be having 2 steps. You will not be tested in a question where we have 3, 4 steps, 2 steps. Both the word is safe to use because we will be only 2 steps. Goodwill is calculated by using both the steps of acquisition. Why? Means you had been recording the cost of investment, always a single one-off figure, cost of investment. Now you'll be recording the 2, cost of investment part 1, cost of investment part 2, 2 steps. Why is it happening? Because when the very first step was taken, there was no control. How could you see me calculating the goodwill standing it on that day when there was no control achieved? It was in fact an associate that does not have got anything to goodwill. Well, you don't calculate the goodwill and associate. It was just an associate. The goodwill on that day was never worked since there was no control. Goodwill, we are going to work for the very first time, standing it on this date. By not just taking this step, also the existing one even. So with collective effort, they have started controlling the subsidiary now with 30% to combine with the 40. They have finally started controlling the S. So that's the reason why the goodwill needs to have both the steps for the purpose of calculating the goodwill. You can't just take a 40% step to calculate the goodwill, can you? Or just the 30. It's a combined effect of 2 steps, which is now giving me a control over to S by 70%. So did I achieve the 70 into 1 go step? No, in 2. And with the combined effect, now this has been controlled. So I should need to calculate the goodwill this time around by taking both the steps of investment. I can come to show you the pro forma of it in a while. In fact, the pro forma will be the same, except the cost of investment will have 2 sub points, 2 bullets further coming in. Cost of investment, 2 bullet points. Existing investment, new investment. But the rest will remain the same, NCI and value of net assets. Now try to contrast this discussion to the one I was having it before. Why in that case, I was always like, look, goodwill originally calculated remains unchanged. Why in that case I was not considering the two steps, which now in that case I've started? Because of the nature of case. In that case, to remind you of, on the very first attempt, it was already a subsidiary. So made me to calculate the goodwill, standing it on that day itself by considering only that one step of investment. But in this case, in the very first attempt, it's not a subsidiary. It's not a controlled entity. So I did not. Goodwill has been worked rather being standing it on that date when they have acquired extra 40% interest. So by adding the two, now they have started holding the company by made me to say that the goodwill must have to be worked by taking the two steps of investment. So when you are done with the one case, sometimes it happens you start mixing the points. So it's very good. It's a good thing that when you learn the one point, you try to look back onto the same point of the last case. So to see, okay, why in that case the goodwill was not taking two steps, now in that case they have taken. By talking to yourself, you will learn it more. Okay. Now, after that, the NCI, one has to recognize based on the percentage after step. This is too obvious to write because there is no NCI in the picture before. NCI is there in the picture after step. So I'll definitely have to work the NCI based on the percentage at the year end, which is 30%. So it is too obvious to write. I should have not even written it. That one has to calculate the NCI based on the percentage that we have after the step, which obviously in this case, we have to work the NCI based on the situation of after step acquisition, and the situation after the NCI will have to be 30%. Should be the same point. I have been able to make it onto the side of profit and loss. NCI needs to be recognized based on the percentage at the year end because there is no NCI in the picture before step. It is all after step. Pretty obvious for this point to write, should have not even written. The last thing in this case we have to work is very interesting. See, it was a subsidiary. It was an associate. And after taking a second step, what it has become? Subsidiary. So where the associate has gone? Do you see any associate after? No, it rather has become what? Subsidiary. So as if you have acquired a subsidiary and the associate no longer exists. So we will be assuming over here as if it is disposed. Actually not disposed, but we will be assuming as if it's gone. We have as if disposed it. So on that deemed disposal of associate, we will be calculating the gain or maybe a loss onto it, which actually is not a disposal, but we will be assuming as we had that entity with us, which will no longer be having it with us. So it looks as if we have been able to dispose it out. So one has to calculate the gain or maybe a loss on the deemed disposal of associate will be calculated and will be recognized. I will explain to you. There's the perform of computation for it. Because we have to consider the substance over the form. Substance suggests the commercial reality, economic truth. Form means legal truth. The legal truth is nothing has disposed. This is the legal reality. Nothing has been disposed on paper. But commercial reality is as if you had an associate, which you do not have it after. So as if you have disposed it. So by considering the substance over form, one has to record the disposal gain loss of over to an associate, which will be a deemed disposal transaction, not an actual disposal transaction. The same thing obviously has to fit in. Once you work the gain and loss for this side, the same figure will fit into the statement of profit and loss also. So there's nothing new. I have written it over except the same thing being copied one more time. So if you ask me, the highlight of this case is to calculate the goodwill by taking two steps of investment. That's the highlight of this case. Other points being understood? Let me go to show to you the performance of computation. This is the way the goodwill looks like by having the two steps of investment. With the NCI, we still are taking. With the value of net assets, we still are taking. Except the cost of investment now have got two steps. Step number one, step number two, new and old one. New one means the one that you have just acquired, the second step. And old means the first one, the previous one. Just need to punch it in to work the answer. The figures of both will be given to us. And that's how the way one has to calculate the gain and loss on the disposal of associate, deemed disposal of associate, fair value of the previously held interest minus the carrying amount. Fair value of the previously held interest will be considered to be as proceeds, which we know that actually it's not disposed, but we're just assuming it as if this has been the balance of proceeds, and we're trying to compare it with its book value. Whatever the gain and loss that we are finding, will go and record that into profit and loss. That is the only calculation. And it's like an everyday calculation, the way you calculate the gain loss on the disposal of any plant, proceeds minus carrying amount. Carrying amount will be with us, fair value will be with us. We just need to match the two to find the figure of gain or maybe a loss. With this explanation, we can finally take one question to apply this whole knowledge at, which will enable us to understand this all in a much better way. The figures, when I will bring it in, you will be understanding it more better. But still, if you wish to have a one-time more look over to the points that I have made, I can quickly go over to it. Statement of financial position, I'll have to consolidate because of the reason of reporting day control. Profit and loss can have an effect of mid-year acquisition. For some months, we will have to treat that entity to be an associate, and for some months, we have to treat that a company to be as a subsidiary after. So some months of associate, some months of consolidation, provided if it is a mid-year step. Goodwill have to take two steps, because with one step, the objective is not met. Control has not been achieved. By taking a second step and to combine with the existing, the control has been established. So it's obvious to use both the steps while computing the goodwill. Well, NCI has to be worked based on the percentage. That's all after, because there's no NCI before. The same step is applicable to the profit and loss. While one has to calculate the gain and loss on the assumed disposal of associate, which actually has not gone anywhere, but by considering the substance over form, we have been assuming as if it's gone. So one has to calculate the gain and loss on the deemed disposal of associate, which I have been able to show to all of you the performance of computations. Let's finally take the first question on which this can be applied. Illustrative example 2.5. So Angel acquired 40% of the shares in Delight for 80 million several years ago. Angel has acquired 40% of shares in Delight for 80 million several years ago when the value of the assets were 160 million. Now this 40% is currently an associate or not? This has been the value of investment, which is what we used to call it as cost of investment also. When the fair value of the net assets were 160. Okay. And finally, on 1st of Jan 9, Angel purchased further 35% of shares in Delight for 110. Now by adding the 35 into 40 will give them the control over to S. The fair value of the net assets were 220. The NCA had a fair value of 60 million and had previously held interest had a fair value of 100. So NCA fair value is given. Let's call it slowly on. Fair value of NCA is 60 million and previously held carrying amount is given as 100. Is it the carrying amount? Previously held interest? No, they're providing us with the fair value of previously held interest. So let me highlight it. This is the fair value of previously held interest, means 40%. Or in other words, you can say that this is the fair value of an associate, because 40% is associate previously held interest. Since its acquisition, the investment in Delight had earned an income of 10 million. 8 million of which was being recognized in profit and loss, and 2 million relating to debt instruments measured at fair value that was being recognized in OCI. So out of $10 million, $8 million has been recognized in PL, profit and loss, while $2 million has been recognized in OCI. Or we'll take a note of that when I already have taken a note of it. When we will solve it, we will deal with what is this OCI thing. By the way, this OCI thing in this case is all to do with IFRS 9. It has got nothing to do with consolidation topic. It's the financial instrument adjustment, which on the way, if they have tested us on, I will be giving you an explanation of how to deal it with. The carrying amount of investment in associate prior to the acquisition was 90. Now, finally, they are telling us the carrying amount of an associate, means 40% interest. So they have given multiple things. They've provided us with the carrying amount of associate. They've provided us with the fair value of associate. And this has been the cost of associate, because initially 40% was acquired by 80 million. This is the historic cost. This is the fair value. And this is the carrying amount. So we have been provided multiple values of associates. Which one are we going to take? Which one we are not? A lot of confusion is there. By being a student, you will be confused about. A lot of text is written and may not be able to connect from where we have to start and end this on. So let's start with analyzing. Which example is it? Illustrative example 2.5. First of all, this company was held as an associate by the percentage of 40%. $80 million several years ago, when the fair value of the assets were $160 million. On 1st of Jan 2009, 35% of the shares in Delight for 110. So they have acquired this interest, has gone up to this has gone up to 75%, because they just have acquired 35% of an interest, which has made this company to call a subsidiary now, because they have just acquired 35% or 30% of interest has just been acquired. Okay, so it now has become a subsidiary. All the way from an associate now has become a subsidiary because of that 30% step. When have they taken this 30% step? I already have noticed 1st of Jan 2009. Now that is the day they will start consolidating the subsidiary. That is from the day they will be working the goodwill also. So let's go to work it out. This is the day standing on, they'll be working the goodwill. And the goodwill this time will take 2 steps. Surprisingly, for the very first time, the goodwill is having effect of anything. So, but then that's the need of the case. It's not something that is your choice. The case demands the goodwill to be worked by using 2 steps of investment, not the one is enough. Okay, so fair value, 35% acquired. Okay, I may have written some wrong percentage. Yeah, 35. Thanks for correction. Okay, cost of investment will take fair value of the consideration paid. and fair value of the previously held interest. Fair value of the previously held interest. I also can label it for your reference. This is for the new interest, and previous itself means old, but still I can write the word old with this. Can't you see me using the two steps? I just need to punch in the figures of both they're providing us. First of all, let's top up the NCI in it and subtracting the fair value of the net assets. So this is how the way the goodwill will have to be worked. I've been able to prepare a blank pro forma of it. Let's start punching the figures. What is the fair value of the NCI? What is the fair value of NCI? The question provides us with fair value. Where is it? First Jan, angel purchase for the 5%. This the NCI had the fair, NCI had got the fair value of 60 million. 60 million. And the value of the net asset standing it on that day was goodwill is worth the time the company is acquired. So standing it on that day, they're providing us with the value of net assets, net. Yeah, I missed it out, 220. So fair value of the net assets are 220. 220. Now I only have to consider the value of investment. So I'll go and take those values from fair value of the consideration paid. Angel acquired 40% of the interest in Light for 80 million several years ago. So this is the historic cost, not acceptable. Historical cost. Must have to take the value of the previously held interest, what is today. Today means the date of second step, which is the date of acquisition. So the date they have taken a second step is in fact the date of acquisition. So I have to see the fair value of this older investment in today's terms. Historic cost cannot be used. So what is it? They had provided us. The fair value was 60 million of previously held interest, 100 million. Sorry, this was the fair value of NCI, and the previously held interest had the fair value of 100. That is given, and I have taken. Don't you make a mistake of using the historic cost. Yeah, what we have paid today is already a fair value payment, so it does not need to be worried for. It's like this, on 1st of Jan, purchase 35% of the interest for this. This is already a fair value. This is the day am I standing right now and paying 110. So what I pay today is already a fair value of that payment. So that needs to be just copied. Problem will be there if you are not going to use the fair value of the previous existing older investment. Because whenever you have acquired this previous interest, that has become a history now. We have to see the value of that interest in today's terms. Today means the date of second step, the date of acquisition. That is 100. So the goodwill is pretty much worked. 110 plus 100. Question is not finished. Goodwill, at least I have been able to work. 110 plus 100 plus 60 minus 220. The goodwill is at least finished. But I'm not saying that the question is finished. We still have lots of things to talk about. And I also can label which is standing in this working is all happening. This is what happening it on the day when they have taken the second step, 1st of Jan 2009. That's 50. The calculation of goodwill. The next thing that I need to work is the fair value, gain and loss, not fair value, is the gain loss on the deemed disposal of associate. Let's go to work. Fair value of the previous interest minus the carrying amount of the previous interest. Now the fair value is what we have used it just up there as $100. And the carrying amount of that was given to us. What was given? The carrying amount. Is it the carrying amount? No, that is the carrying amount. As they have said into the last line, the carrying amount of the investment in associate prior to the acquisition was 90. This is the gain that we have got on the deemed disposal of associate. not actual, deemed disposal. I can make the title of that the gain on the disposal of an associate, which is a deemed disposal. I can also go and pass the double entry for this gain thing. What has to debit, what has to credit, be with me in it. We'll have to credit the profit and loss or retained earnings by the amount of $10 and debit what? Actually, did I receive a cash? Because in normal transaction of sale proceeds, you rather debit the bank because you get the cash. We're not getting the cash over here because actually it's not disposed. So can't think of debiting the bank over here. What am I supposed to debit? Investment account. This will be taken into profit and loss or retained earnings. Where are we going to take this? In fact, we already have taken this up. Check this out. At what value the carrying amount of associate? What is the value at which the associate was currently being carried at in the books? 90. So how come that 90 has gone up to 100? By adding the 10 in it, this has taken to 100. This is the value at which in the books the associate was currently carried at. It has gone up to 100. How come? By debit the 10 from here. So that is a double entry. Calculation of gain loss on this disposal and debit the investment account, credit the profit loss. This has to be taken into profit and loss retained earnings. The debit of that has been taken up there. This is the value at which the associate in the books was carried at. How this 90 has gone up to 100? By debiting the investment account by the gain on the deemed disposal of associate. That takes the whole 90 up to $100. The question is still not over yet. Main things I have been able to talk about. Main things means I have been able to work the goodwill by taking 2 steps of investment. I have been able to work the gain loss on disposal of associate, but still there's something left, which actually is in regards to financial instrument topic, not the topic of the moment, and I can come to it just. If you look into the solutions, they have worked the goodwill exactly the same manner we have worked. Is it? Okay. I was going to explain to you something. Pay attention to. See, the first thing is the cost of previous interest. The cost of previous interest. And the second thing is that the carrying amount of previous interest. The third thing is the fair value of the previous interest. There are 3 things in the question that are providing us with regards to associates. The cost is 80. I hope I don't have to say the cost is 80 because it's quite much readable from the very first line. That's the cost they have incurred in buying that interest originally, historic cost. While the carrying amount and the fair value is the one we have been dealing it with in the recent explanations. The carrying amount was 90 and the fair value was 100. I am here to explain to all of you how come the 80 has gone up to 90. How come the 90 has gone up to 100? This is what I am wanting to make you understand. This at least we have talked about already. Haven't we talked about this $10 million gain? Just about 2 minutes ago. How come the 90 has gone up to 100 with the gain on deemed disposal of associate? I have been able to explain. So at least this part is fine. We need to understand how come this 80 has gone up to 90. This is something I need to explain. Are you at least fine with this $10? What is this $10? Gain on the deemed disposal of associate. The calculation of that I have been able to show to all of you pretty much on the up alongside its double entry. This 90 has gone up to 100 by the recording of the gain of disposal. But how come the 80 has gone up to 90? For this, they are telling us the story. That story is on the top of the next page. Since its acquisition, the investment in Delight had earned an income of 10 million. So this 10 million is in fact the return on investment. Return on investment, with that, the value of investment has gone up to 90. 8 million of that has been reported into profit and loss, while the 2 has been taken into OCI. So this 10 million is in fact that amount, out of which they have recorded the 8 million into profit and loss and have taken the 2 million into OCI. Okay, something I can connect. How come the 80 has gone up to 90? If you can remember the equity method of IAS 28, or let me bring out the file of the page, chapter 1 in front. Let me land myself onto that page where this explanation was done the last week. Equity method of IAS 28. Investment in associate is recognized as a non-current asset in the statement of financial position of parent under this method of this standard. Is it? So the way that working is performed, it takes on the very first the cost of investment. Suppose in this question, the cost of investment is $80. Why to suppose? Cost of investment is $80 really. So how come that has gone up to 90 then? By the recording of the share of profit, this has gone up to 90. So that is actually happening there. That's how the way the 80 has gone up to 90, because of that return of investment, group share of associates post-acquisition reserves. So this $10 that they have recognized is in fact the same group share of associates post-retained earnings, that by adding this into 80, this has gone up to 90 in the books today. It's the application of equity method. This how the way the 80 has gone up to 90. From 90 to 100, I already have explained what is happening. But from 80 to 10, it's equity method. So if you know it out, then you can actually sense it. You can say that I know this background of 80, how this has gone up to 90. I know the background of it. The background is in fact the equity method of IAS 28. Okay, connected. Now I need to talk about something in regards to this OCI thing. According to IFRS 9, any against those has been recognized previously in OCI are reclassified to income statement upon the disposal of an investment, which in this case we are assuming as if this investment is disposed today, deemed disposed. So I need to reclassify the portion of the gain that has been recorded in OCI previously are going to be reclassified on the disposal of investment, which is right now we are assuming that it's a disposal happening on. How the way this reclassification adjustment one has to pass? I'll have to come debit the OCI and credit what? Profit and loss. This is a reclassification adjustment, the debit of OCI and the credit of 2 million. So as a result of that, what's getting into a statement of profit and loss will turn up to be 12 million in total. Or I can combine the two double entries also. I can combine the two double entries to make the one. Will be having 3 effects. I will have to debit investment account by $10 million, OCI by $2 million, and income statement by $12 million. Okay with this, I've been able to combine the 2 of those effects to form the one. This is the effective double entry on the deemed disposal of associate we have to pass. So any gains, those have been recognized previously in OCI, are reclassified to IS upon the disposal of investment, which right now we are assuming as if the investment is disposed. So whatever the gain that has been recognized previously has been reclassified to profit and loss. And this also have got one thing to remember, provided this in regards to a debt instrument, this will be done. If that was in regards to equity, it would have not been done. This $2 million is the fair value gain, has been recognized into OCI. So if it in regards to equity, you have found the reclassification is not allowed. If it is in regards to debt instrument, the reclassification will be done according to IFRS 9, but in regards to equity investment, it cannot be done. It's written over here in 2 points. OCI relating to valuations of plant, pensions, and equity investments would not be reclassified. So forget about the valuations and pensions for a while, at least concentrate on the type of instruments, equity instruments would not be reclassified. But if it is in regards to debt instrument, it will be reclassified. The reason why in that question we had been able to reclassify because it was in regards to debt instrument. If you look into the solution of that, the same has been done by the solution. If you look in investment in the light takes the debit by 10. This is the reclassification adjustment. And profit loss takes the credit of that, collectively 12. Pretty much been able to explain every aspect of that. May it has been tested from IFRS 9, still being able to talk about it. Now you are probably okay with how come the 80 has gone up to 90. It was under the equity method of IS 28. Then out of the whole change which we have recognized, 2 million of that has been recognized into OCI, was needing to be reclassified upon the disposal of that investment, which is what I came down to. While up there, gain or maybe a loss on the disposal associate was easy to find. And even the goodwill, that takes 2 steps of investment. So finally, discussion-wise, this case has come to an end. And after spending, again, about 40 to 45 minutes, we are pretty much done with the case that we have opted for. Every case requires to have an explanation with a lot of patience. You also have to be there listening to it and then revising it as hard as you can. In the live course, if you are finding it tougher and realizing it, that this is something that I will forget. And if you will not touch it even after by yourself, you will definitely. With logics, I'm explaining to you every bit of it. I'm writing it there, not you to cram these points. Okay. We're about to get into a third case and the example based on to that we have to solve. We will take a break for 10 minutes. And when I will resume the session after 10 minutes, we definitely will have a discussion coming to the third case. Do not go anywhere. A lot of constructive explanations are still waiting for you to learn in the course of today. I will see you in 10 minutes to resume the session. Okay, I'm back. Hoping you're also there with the continuation of the same topic with almost a little more than 1 hour left. We are getting into the last case on which we have further 2 questions to work. Hopefully, we'll be able to start off with the disposal aspects towards the ending part of the course, but safely, the next 30 to 35 minutes are on the stiff acquisitions. Yeah, third case. If you look into a third case, will be the same as the second one. The difference will only be the one, except simple investment instead of associates, we will be starting to work the simple investment under the IFRS 9. I'll take you to the page on which the summary points of this case is written are written, and you won't be surprised to see exactly the same stuff written. Statement of financial position, statement of profit and loss. This is the day they have taken a second step and have started controlling the S. So as long as they are controlling, the statement of financial position will have to be consolidated normally. Regardless of the fact, whenever they have taken a step during the year, start of the year, after taking a step, now they have started controlling and standing it onto the date of reporting, they'll be having a control. And that makes me to say, we have to consolidate normally. That makes me to say we have to consolidate normally. But statement of profit and loss, as I have been talking about, what if the step has been taken during the year, that for some months, we will be recording this to be as simple investment, and for some other months, they have to consolidate. Exactly the same thing I have been able to write. Simple investment is recognized under IFRS 9 till the date of this step acquisition. And that could be 4 months, that could be 3 months, 5 months, 6 months, depending upon when is the day they have taken a step. Before then that, they have to record this investment to be as simple. Consolidate as from the date step is taken. Some months of simple investment, some months of consolidation. Same thing I was talking about. There, I was like some months of associate, some months of consolidation. I just have changed the associate to simple investment. That mid-year acquisition has got no effect on statement of financial position, because statement of financial position one has to consolidate by the reason of a control standing it onto the date of reporting. Isn't it the same story as before? Must have to calculate the goodwill by considering both the steps of acquisition. And you should know the reason why. Because in the very first attempt, the control was never established. It was established when the second one was taken. So with the combined effect, now they're having a control over 2S by 70%. So must have to use both the steps while computing the goodwill. I don't have to explain this to you more, because you already have seen me explaining the whole need for 2 steps. What NCR one has to calculate based on the percentage that we have it at the year end after step. This is obvious. Since there is no NCR, one has to consider in the picture before. It's all after. And this time I need to calculate the gain and loss on the deemed disposal of simple investment. In the last case, it was a deemed disposal of associate, which I have just changed to term the simple investment. Literally, this case offers the same that you have done it with me in detail in the case of associate. Wherever the word associate had been used in the previous case, I have been able to replace it with simple investment. And yeah, obviously, associates are to be treated by using the equity method of IAS 28. Simple investments will have to be treated according to IFRS 9. But broadly speaking, the discussion remained to be the same as before. No such bigger difference we have seen. Okay. So rather we can take one question from this case thread also to make sure that we have covered up the questions of each of the case and can spend a bit of time onto it. That question is coming to our way is illustrative example 2.6. Yes, it is. As it has been seen on 1st of Jan 2009, he acquired 50% of the interest, which is the simple investment, which is simple investment. The cost of that being given as $15 million. The financial asset investment was classified as measured FETOCI. So they have been classifying it as FETOCI financial asset. At 31st of December 9, T acquired 40% of an interest in D at the cost of $60 million. So this is going to be a second step. And by combining it with 40, will go to give us a little bit of control over to S. Yeah. The fair value of 15% interest at the time was 21 million. And this has been reflected in OCI in accordance with IFRS 9. So probably this is going to take us back to the same reclassification thing. I did explain to you in the previous question, IFRS 9 reclassification. The NCI had got this much of fair value. The fair value of the identifiable net assets were 100. The group recognizes the NCI by using the fair method of NCI. So the question looks to me a familiar kind of. The only difference to this question to the one we are doing, in that question, we had an associate in the picture before. This time we had a simple investment in a picture before. Well, the picture after is same by taking the second step has become a subsidiary. So let's start analyzing this illustrative example 2.6. Okay. This is the day the year starts, and this is the day the year ends. So by half are they holding this company? They've been holding this company by 15%. So when this has been acquired by extra 40% of the step, this has gone to 55% just because they have acquired 40% of the interest. This was a simple investment, which is also called as financial asset, which has gone up to now a subsidiary. Case identification is important before we get into the solution and all. Case identification is a lot important. So this is the day we have to stand on and calculate what? The goodwill. This is the day we have to stand on and calculate the goodwill by taking the two steps of investment. Just give me a second. Okay. Fair value of the consideration paid to acquire a newly bought interest, fair value of the consideration to acquire a newly bought interest and fair value of the previous interest. That's how the way in the previous question I was working those figures. I just need to work this out the same way as before. Topping it up this by the amount of NCI and subtracting the value of net assets. The fair value of the NCI has also been given. I just need to throw in those figures in because all the figures had been provided to us. Okay. So at December 90, acquired further 40% of interest in at the cost of 60 million. That 60 is given and have been able to copy and paste. Given and been able to copy. Well, what has been the fair value of NCI? 58.5 being given and taken. And what has been the value of net assets? The fair value, the net assets were 100, also being taken. The last thing that needs to punch it in is the fair value of the previously had interest. So we have to take a fair value, not the historic cost. The historic cost has been given to us in the very first line, but this is not acceptable. We have to see the value of that investment today, and they have given to us over here. The fair value of 15% interest at this time was 21, and I have been able to take 60 plus 21 plus 58.5 minus 100. The figure has turned up to be 39.5. That's goodwill. For the second time around, in a space of 30 last minutes, I have worked it for you. Like in case 2, in the case 3rd, we have worked the goodwill by taking 2 steps of investment. Now we will try to calculate the gain loss on the disposal of an associate, which requires me to use the fair value of the previous interest, comparing it up with its carrying amount of the previous interest. The fair value is with us. The fair value is 21. The carrying amount is something that we need to spot. Let's go to spot it. At December 90, acquired the further 40% of interest in D at the cost of 60 million. That's fine. And obtained the control. The fair value of 15% of interest at this time was 21 million, which had been reflected in OCI. Which has been reflected in OCI. What is it? The fair value of 15% of interest at this time was 21 million. The fair value of the identifiable, the fair value of 15% of interest at this time was 21 million, which had been reflected in OCI in accordance with IFRS 9. See, they have been keeping this investment as FET OCI. The historic cost of that investment was $15 million, and the fair value of today is $21 million. In accordance with IFRS 9, they are suggesting the gain of $6 million, they already have reflected. What does that mean? It means they have been able to already revalue it. With the resulting gains had been recognized in OCI already, which is 6 million. Let me also go to pass the double entry of it. This is the double entry that I'm not passing it. This is what they already had reflected. FVTOCI financial asset debit, OCI credit. This double entry already been treated. Already been treated. I'm not saying it, they're suggesting. This has been reflected in OCI in accordance with that. It means they had been able to fair value this investment, and the resulting gains of whatever we have, they had been recording it. They already have treated that out in OCI. So the book value of this investment today will be the same at its fair value. No gain, hence will arise. This is what I was wanting to explain. They have been keeping their investment at FET OCI. According to IFRS 9, they already had reflected the fair value change in OCI, which effectively means their value of investment has already been kept at its fair value. So when I will try to compare it up with its fair value, book value, fair value, both they turned out to be the same. Hence, no gain or maybe a loss on the deemed disposal of simple investment is found. No gain or no loss on the deemed disposal of simple investment. It's as if just before the date of disposal, you have been able to revalue your property, plant, and equipment up to its fair value. So on the date of disposal, will you be getting gain loss? No, because just on the same day when the asset was being disposed to its fair value, the same already in the books you have been able to reflect by valuing it. So on the date of disposal, neither the gain nor the loss will even be worked. That is what is happening over here. Or if they had been keeping their investment at cost model, then they would have been keeping this 15 forever at 15. But no, they have been opting for this classification, and by using the IFRS 9, they already had been able to fair value it, which already has taken the cost up to its fair, which now has become the book value. So on the date of disposal, when you compare this off to its fair value, which turns out to be the same as its book value. Okay. Last thing that needs to clarify, do I need to reclassify the amounts previously being recognized into OCI to IS? For that reason, we should come down to remember that in regards to which type of instruments we are allowed to reclassify. So in regards to equity investments, we are not. So holding the shares into that company is an equity investment. So in regards to that investment, the OCI has previously been recognized. So I will not go to reclassify. Everything step by step, I'm explaining it. No reclassification adjustment is required since the gain that had been recognized previously in OCI is in regards to an equity investment. According to IFRS 9, it is not allowed, or it is prohibited, or it does not permit the reclassification of any gains being recognized previously in OCI in regards to equity instruments cannot be done. So I'm not doing it. That's the end of this question. Look into the solution of that to see if they're suggesting all what I even have. First of all, this is the same answer of goodwill as I even have got. 39.5, is it? Yes, it is. Other than that, what are they trying to explain to us? There is a difference of carrying amount and fair value at the date the control is obtained. But as the IFRS 9 has been applied correctly, the financial asset carrying amount is its fair value now. Means carrying amount, fair value, both the same are. Therefore, no gain or loss on the deemed disposal such will arise. This is the whole explanation. I've done it with you. They have just been able to fair value it. So the carrying amount of the asset becomes its fair value, or the fair value of an asset becomes its carrying amount. So today, if they have been able to sell, they won't get any gain and loss, which is what I had proved it out also before. And then this amount, they have been recognizing it OCI, will not even be reclassified. Why? Not being allowed by IFRS 9. So exactly all of the stuff I had explained to you before. When you try to read out the text written back into the notes, you feel it like it's okay, it's understandable for me. So reclassification adjustment is required when it is in regards to debt instrument. And some other list of components are given there. Foreign exchange gains, the cash flow hedges. Obviously, these topics are not the ones you have learned so far. So only keep the thing simple that in regards to debt instrument, the reclassification one has to perform, but in regards to equity, it is not allowed. So which right now is equity because holding the shares into that company is an equity investment. And in regards to that investment, they had been recording the gains into OCI previously, which cannot be reclassified on the deemed disposal of this investment today. This was the one part. And the second part was to understand no gain or loss on the deemed disposal, just because before they had to dispose of this investment, they had been able to fair value it already. So carrying amount and the book, the fair value, when both they turned out to be the same, neither the gain or loss on the day of disposal that they will find, which in fact is the same day of disposal as the day they have done the valuation. So we are pretty much done, except this one question requires us to work something onto it. We also can, but I have been showing to all of you the way things are written. See, this is the whole text in between. These are those performas which I have been working on. If I try to look back into lecture notes just to see the way things are written in, see, gains, goodwill is calculated by using those two steps. This is the step number 1. This is the step number 2. While NCR, you may write it in between the two, or you may write the NCR over here. That totally is your choice. Preferable to write both the steps together and then NCR to come afterwards. And then the second thing is to calculate the gain and loss on the associate fair value of previously held interest less the carrying amount. The reclassification thing I already have been able to show to all of you how to invent. And a little bit of text in start. But the way I have made the summary, points of both of the statements are worth looking at rather reading the text and trying to make your life a little confused further. But not much text is written there, but still if you would wish to try to read it out, the same message, you will be getting it, what you already have received from my explanations. Also, in regards to simple investment, simple investment is financial asset investment to subsidiary. So same kind of a text is written for which I have been able to make the summary points. So you read it, you don't read it. If you have learned and have followed my board work perfectly, you have learned it. This was the first case in which the equity adjustment was worked. So that's how the way the equity adjustment one has to recognize fair value of the consideration paid less the transfer from NCI, a 2-line pro forma. Types of acquisition. This way, the topic starts by defining the 3 cases. And I also have defined the 3 cases by this way. And I guess it is more presentable rather to look into this way: case 1, case 2, case 3. Subsidiary to subsidiary, associate to subsidiary, simple investment to a subsidiary, with examples are also being given. Thoroughly read your lecture notes. You should be having the habit of doing it. But I have made sure that whatever you're going to read it out, while reading it out, you will be having this kind of an impression that you know what's written there, since technically speaking, logically speaking, I have been explaining that to you all. Let's do this question also. They have asked us to work before we take ourselves into the disposal aspects of the subsidiary, which is going to be the second phase of this topic. Calculate the goodwill arising on the acquisition of control. Let's see from which case they have tested this question from. This is the learning example that might have tested us on either of the 3 cases. We still have to see which case this question is testing us on out of 3 cases we have done. At the start of the year, L acquired 10% of G. Yeah, so they are testing us on the same case we have just got over to, simple investment. At the cost of 25 million. classification. Now they did choose for FATPL classification with the measurement taking place at the end of the year in accordance with IFRS 9, which usually is the case. You try to remeasure your investments, your assets at the end of the year. Partway through, L acquired the further 45% of the G at the cost of this much, so has obtained the control. The fair value of the NCI was 10%, at that time was 27, and the fair value of the NCI was 110. The fair value of the identifiable asset was 150. So quite much doable. This question, the way we have done many questions before, we still can do it and try to finish it as early as we can, so that in about next 10 minutes, we can get into the disposal aspects. With further 30 minutes to go, we can have a good explanation on disposal aspects. Learning example 2.5. Okay, at the start of the year, there is an interest of 10%. And at the year end, there is an interest of 45%. How come this 10 has, no, not 45%, 45% is what they have acquired. The interest has gone up to 55% just because they just have acquired 45% interest. It was a simple investment, not transferring or forming up into a subsidiary. It was a simple investment, but transforming it out into a subsidiary. And the same case, we just have got over to this has been tested from. So standing it on that, they have to calculate the goodwill. Let's do it. Let me try to copy and paste the proformas rather to waste time on rewriting it. This proforma I can simply copy and paste from the explanation to fit onto this page. Saving of time. Let me insert those figures into it. And the figures are given to us. The fair value of the NCI is given. Now, these are those proformas that later on the spreadsheet one will have to prepare. And it's easy to prepare because this is all about typing narratives. These are, and the cells in front of it will require you to punch in the figures, and some of the cells will require you also to apply the formulas, like sum function in the end, or NCI fair value if you will be asked to work, so you will be using the sum function. So a little bit I can comment onto that when I will take you into the exam level practice, but this proforma making is totally onto a spreadsheet. Explanation part is onto the word processor, and let the time come, you will see me formally being talking about how to plan your answer onto the spreadsheet, especially the question 1 of exam, which will be having the proformas of computations. Partway through, lady has acquired further 45% of the interest in Gaga. This is 45%, 120. This I have to copy and paste just like it. Well, the fair value, the previously held interest is given very next to it. The fair value of 10% interest in that time was 27. So it's given, and we've taken the value of net assets 150 and the NCI 110. Goodwill is pretty much over. 120 27 plus 110 minus 150. The figure turns out to be 107. The figure turns out to be 107. The figure has turned out to be 107. The calculation of the goodwill is pretty much done. Now let's go and calculate the gain loss onto the disposal of simple investment, which will require me to also copy and paste this proforma. I have those proformas with me, so I can simply use them or rather to rewrite them. Okay. What has been the fair value of the previously held interest? The carrying amount and the fair value. The fair value I've just used up there, and I can copy and paste this amount 27 once again down below. 27. And just can wait for the carrying amount to come to my way. And the carrying amount has to be for how much they acquired this investment in the past. So they say at the start of the year, lady acquired 10% of an interest in G at the cost of 25 million. And they have been recognizing this at fair value through profit loss, with the remeasurement taking place at the end of the year in accordance with IFRS 9. So it's not that they have done the valuation already. They're suggesting that with the remeasurement taking place at the end of the year in accordance with IFRS 9, which obviously so far has not yet taken place. So the same value, they will be keeping it in the financial positions today at, which makes me to calculate the gain of $2 from. Makes me to calculate the gain of $2 from. Gain of $2 from. A double entry to follow. What has to debit, what has to credit. Needs to debit the investment account and needs to credit what? Have to debit the investment account by $2 million and credit what? Profit and loss or retained earnings. This is the same debit which has been taken up there, because this investment was originally being carried at 25 but has gone up to 27 by adding the 2 million gain into it. I also have explained this point to you off in one question above, that this 25 is the value they're keeping this investment at. How come that this has gone up to 27 by recording the gain? And this question is not about reclassifying, because nothing in the past has been recorded into OCI that I can think of even reclassifying. Pretty much ends up this question. So by spending 2.5 hours of the course of today, we have been able to finish the STIP acquisition, the one half of the course. Usually I told you that it takes one course on STIP acquisitions, one course on disposal. But just because in the last week, we have been able to spend 30 minutes of odd explanation on STIP acquisitions, which today we have been able to save a bit of time of today's course from. But usually it takes 3 hours on STIP acquisitions and 3 hours on the disposals. But we have a time. Definitely, we can start off with the disposal aspects, which is into the same chapter. But obviously, we will be having some separate notes coming to our way for disposal aspects. So let me take yourself to disposal aspects, and I will take myself onto a page where this topic has been introduced. So let me try to find it up from my file. First of all, you have to look onto this page. I told you when this topic started off that, look, we have 2 sections to focus: STIP acquisitions and disposals. This part is pretty much being done. And now we are heading towards to this part, which will be a continuation of STIP acquisitions. Whatever the knowledge you have gained, quite much will be the opposite of that. Because here you have been taking a step. There you'll be disposing a part of it. So it's going to be quite much of a U-turn. There you had been acquiring extra interest. There you would be selling a little bit of interest, maybe the full. I have got some cases to look at. Full disposal might be involved, part disposal might be involved. So broadly speaking, the disposals of the subsidiary will be the opposite of what we have done for STIP acquisitions. Many of the things you have done it onto STIP acquisition side will be the opposite into the discussions of disposals. So it will help you. Let's start off with disposal aspects. I'll land onto a page on which the cases have been defined at least, and there you go. It's the same file within which I have been doing this whole board work from. So that is the first page. Like when I started off with STIP acquisitions, I was trying to introduce the topic by bringing it down to 3 cases. This is the starting page of the disposals of the subsidiary. Let's try to place it in front for a while. Let's try to patiently look into it before starting to pick the one case and having the words over to it. And chapter 2 starts off with the disposal aspect. So I have been able to bring myself back to the very first page of this chapter that has got the disposals being discussed upon. Okay. I have been able to place this page in front to at least try to view the number of cases we have to look under. In total, there are 4 cases. 1, 2, 3, and 4. Can you see? 1, 2, 3, and 4. There are 4 cases to look under. Broadly, full disposal, part disposal. Full disposal, part, and full means when the subsidiary is disposed entirely. You can look into the examples down below also just to learn. This is what they had been holding it by, and they've disposed the entire interest to have nothing after. That's full disposal. But part disposal is where they have disposed the part of the interest. And even in the part disposal, we will expect to see some cases coming under control loss, control retained, control loss, control retained. So looking into the case of control lost, there are 2 possibilities to look further. A case in which it was originally a subsidiary, and by disposing a 30% of the interest has gone down to where? 40%. Associate. Isn't it the opposite of what we have done before? There, the discussion was associate by taking a second step of investment has become a subsidiary. Now, there we have a subsidiary, and after subtracting the disposal of its interest, it has become an associate. It's exactly the opposite of those cases we have learned it before. Subsidiary, it is, and after disposing a part, becomes what? Simple investment. There it was simple investment, by taking the second step of investment was becoming a subsidiary. And you should also be remembering we have done the case where it was a subsidiary. By taking a second step of investment, it has become a more controlled subsidiary, which will be the opposite now. It originally is a subsidiary, and after even disposing a part, remains to be a subsidiary, but by a little bit of less control, 90 to 70. Even the definition of the cases are suggesting it's plenty of stuff coming back to our way, which we have done already while discussing the step acquisitions. But obviously, in an opposite manner, we have to take a good care of the knowledge we have got, the effects that we have learned, plenty of that coming back to our way. If you have got a good idea of the step acquisitions, then you can understand the disposal aspects. Or this applies to the case, if I start off with the disposals first, the knowledge of the disposal will help you in learning the step acquisitions. Either of the 2 sections can be done first. I have done the step acquisitions first. It's definitely going to help us out into the disposal aspects. So what should we do first? Which case we should take first to try and understand? Should I start off with the full disposal? What is there into the lecture notes? Let's take it on to the first. Let's start off with full disposal. Very interesting. Full disposal is the case in which the subsidiary was being controlled, and by disposing the entire interest into it has become what? No subsidiary. Loss of control. I did not say loss of control over here because it's pretty obvious. By disposing the entire interest into a subsidiary, this is definitely a loss of control. So it's obvious not to write the control lost there. The definitions of the case are fine. You people have been able to see. Obviously, we'll keep on visiting this page afterwards. At least I have been able to introduce this topic by showing to all of you there are in total 4 cases we are going to talk about. 3 under the banner of part disposal, and 1 itself is full disposal. In a part disposal, control lost is one possibility, control retained is a second possibility. Let's start off with full disposal. As you can see also on the next page, same pattern I have followed. One page for SOFP, one page for PL, followed by those bullet points. And nicely being introducing the title of the topic, full disposal, 80 goes down to 0 because of the disposal of full 80% interest. Okay. So what will be the effect of full disposal on the statement of financial position? What will be the effect of that? It's pretty obvious, by the way. It's pretty obvious because of the loss of control, we cannot consolidate. The control is gone, and that makes me to say not to consolidate. That's what I write it in start. No consolidation because of the loss of control, because of the loss of control. No consolidation. Yes, for profit and loss, what if the disposal has been there in the year during mid-year disposal? Then for profit loss, we still have to consolidate till the date of disposal, mid-year disposal, 6 months, 4 months, 5 months, 8 months, 2 months. Profit loss can still be consolidated for the number of months till the time they're having a control. SOFP cannot be. As the loss of control has been there, standing it onto the date of reporting makes me to say not to consolidate. And the highlight of this case is what? A new calculation that never in the life we people have done it before. Gain or maybe a loss on the disposal of subsidiary will be calculated and recognized. Gain or maybe a loss on the disposal of the subsidiary will be calculated and recognized. So what is it? How to, when to, why to, first of all? Why did we calculate this? Why are we supposed to calculate the gain loss on the disposal of subsidiary? Because there is a real disposal happening right now. It's not a deemed disposal anymore. Really, the subsidiary, you had been controlling it once, today is disposed out. So one has to definitely calculate the gain loss on it. So this is going to be a pro forma of computation, which I also can come to show to all of you for the first time. Such a nice, organized pro forma of the computation, which is what you people will have to remember. If this will be required to prepare onto a spreadsheet, the same pattern one has to adapt in preparing. It takes it on the very first, obviously the consideration. Upon the date of sale, what did they get? That is the first thing one has to take it. What next? In the inner column, we'll have to try and find the value of the subsidiary. Whatever is happening into inner column, whatever is happening into inner column, we are trying to find the net worth of this subsidiary by combining the net assets of subsidiary, adding the goodwill into it, subtracting the NCF from, because the net asset and the goodwill both are the debit nature balances. The NCF is the credit one. So definitely from the list of it, the NCI has to deduct. Don't make a blunder of adding it. NCI has a credit balance, or the net assets, the goodwill are the debit one. So these three figures we will have to try and put into the inner column so that we can find the one single figure out, which will be with the match of proceeds, we might end up getting the gain and loss. That's how the way one has to work. The gain or maybe a loss on the disposal of subsidiary. Why are we calculating it? Because there is really a disposal of subsidiary going on. So there's no question mark for anyone's mind that, okay, why? Just the way you dispose of a plant. So don't you calculate the gain loss on the disposal of plant, land, motor car, intangible asset, whatever. So it is an actual disposal transaction. So one has to definitely calculate the gain or maybe a loss on the disposal of that investment subsidiary. And that has this way to work. Importantly, sometimes you will be asked to calculate the gain or maybe a loss on the disposal of the subsidiary in the individual financial statements of parent. And this is another calculation, because we have two financial statements. The one is for parent and the second one is for the group. So there are two calculations you can be asked to calculate: the one that you have to do it for the group financial statements and the one that you have to do it for the individual financial statement of parent, which is kind of an everyday task. Because in ordinary disposal, this is how the way we calculate. We try to compare the proceeds with its carrying amount to find the gain and loss. So fair value of the consideration received, in fact, is the balance of proceeds, which I am trying to compare it up with its book value. It's an everyday calculation. You calculate the gain loss on the disposal of plant the same way. Proceeds minus the book value of asset. Is it? So main thing is this calculation, which will be more examined. This can also be examined. So you should be also aware of that. Okay, there is a calculation. I also need to know to work for the individual financial statements. These performers are not going anywhere. The copy of this file then will be shared to you. You will get an access to watch it. You again have to more concentrate about the way the computations will have to be performed, not trying to copy it down or trying to that case requires to have no further explanation. What am I supposed to talk about further when I'm saying that in the very first step, no to consolidation? It means I don't have to say, I don't have to be concerned about how the way the goodwill one has to calculate NCF, because I'm not going to. No consolidation. So this does not really matter this time, how to calculate the goodwill, how to calculate the NCF, how to calculate this. When in the first step, I have said it, look, no to consolidation. Nothing I will calculate. Nothing I will recognize. What needs to be is the calculation of this gain and loss. The performance of that I have been able to share out with you, and I can do a question on that very formally to see how to quantify it. And this is the gain on the group disposal in the group accounts. This is the first calculation, and just the same kind of a picture. Two columns. The inner column has got the proceeds. And the inner column has got the same three items: net assets, goodwill, and CI. You're trying to find the carrying amount of subsidiary by using these three pieces of information: net assets plus goodwill minus NCI. All of the three items, when we had consolidated, we have recognized. Can't you remember? Assets and the liabilities of the subsidiary were consolidated, combined it. Today we are trying to de-recognize. Goodwill was recognized. Today we are trying to de-recognize. NCI we have recognized. Today we are trying to de-recognize. So it's exactly the U-turn. All of the stuff while consolidating, we have recognized. Net assets of subsidiary, goodwill of subsidiary, NCI of subsidiary. Today we are just removing it out. But we will have to find the one net effect of that removal by presenting this into inner column. And that net effect will be one figure. Compare it with the proceeds to find the gain and loss. And this is the gain in the group accounts, no, in the individual accounts of the parent, which takes hardly the two things: consideration minus the carrying amount. Followed by this example on which we can really work the answer. Okay. Illustrative example 2.1. So G purchased 80% of the shares of B 3 years ago for $60 million. For $60 million. And elected to measure the investment at cost into its separate financial statements. Okay, so they've been keeping the investment at cost, not FETOCI, not FETPL. The fair value of net assets at the date of acquisition was 65 million. So they're providing us with the typical stuff. Fair value of net assets on the date of acquisition was this. The fair value of the NCI at the date of acquisition was 15 million. G values the NCI by using the fair method. And at June 2009, finally, G has disposed its entire sharehold in the company B for 85 million. When the net assets of the B was 70, there had been no impairment of goodwill since the date of acquisition. So they want us to calculate the amount of profit and loss in the group accounts. That's the first requirement. And in the parents' own accounts, second requirement. Two requirements. Let's concentrate on the main balance, group gain loss calculation, before we can talk about this own account calculation. So on June 30th, the day they have disposed the entire interest, June 30th of June 2009, the disposal of full disposal. Standing it on that date, we will have to calculate the gain or maybe a loss. I assume we have a gain on the disposal of subsidiary. But this calculation, I'm doing it for the group account, so I can mention the name next to it. Group financial statements. Fair value of the consideration received, and free things, we have to take it next to it. The net assets to de-recognize, the goodwill to de-recognize, the NCI to de-recognize. Three of those figures to be de-recognized. A blank pro forma, I should have rather copied it from the up. Another need to write this again. Just need to punch in the figures and we can easily. What was being received? On 30th of June, G disposed of its entire interest in B for 85 million. While standing it on that day, the net assets what were? The net assets of B on that day was 70. But these two are going to be the workings, and we can do it. These two are going to be the workings, and won't be an issue in calculating the goodwill after the whole of the hard work the past 2 weeks. And today, working the goodwill is never going to be an issue for any one of you taking the course. Starts off by taking the value of investment. We purchased 80% of the shares of B 3 years ago for 60 million. That's the cost of investment. $60 million. While the fair value of the net assets is 65, fair value of the net assets. NCI one has to top this up by the amount of NCI. The NCI is $15 million. The goodwill that we have worked originally, the time the company was acquired, 60 plus 15, 75 minus 60 divided 10. This is the goodwill we had worked on the date of acquisition, which because of the reason of no impairment in all those past years, luckily, the same we are finding it to be the answer of the goodwill standing it on the date of disposal. So otherwise, if the goodwill has been impaired by now, you must have to use the impaired value of the goodwill to come and de-recognize, not the original. So 10 was original, turned out to be the same today since no impairment in the past many years has affected that balance. That I have been able to feed it into. NCI on to the next. Taking the first of all its basic value, the fair value, which is what? 15, as being written also up there, and topping it up by the amount of this NCR share of subsidiaries retained earnings. 20%. And this has been the balance of net assets of today. And this had been the balance of net assets of that time. So what they have made since then, $5 million, 55 to $75 million. The answer we have got based on to that is this. This is the value at which today in the books, the NCR is being carried at. So if I do not have to dispose the subsidiary, this is the value at which I would have recognized the NCR today, which I don't have to recognize that today. Rather, I have to go and remove it. So to remove it, obviously, the figure needs to be worked at least the same way as we normally work. Let the calculator do the rest. 70 plus 10, 80 plus 16, 64. So when I will compare this 64 with the figure up there, this is the gain that I have found, which is getting where into in the group financial statements. That's how the way this calculation must perform. And if on the same question, they have asked me to work the group, which they have asked me to work the gain on the disposal of subsidiary in the individual financial statements of the parent, which will be a straightforward calculation, will not be bringing any sort of complications in the individual financial statements. The name of that is the parent G course. We'll take 2 steps. Fair value of the consideration received. Fair value of the consideration received, while the carrying amount of the interest disposed. An everyday simple calculation. Receipt is 85, while the carrying amount of the investment will be the cost of that itself, which is 16. Because they've been recording this investment at cost. So whatever the cost that they have paid in the past must have been the book value today. 25. You even feel it like the main computation is this one. But this you also can be asked to work. So we have worked it out also. I have been able to show to all of you, even back into lecture notes, the way those performers were written and whatever the text was written, even being checked into. If the parent sells its entire sharehold into a subsidiary, cease to consolidate. My wordings were like no consolidation. So cease to consolidate, no to consolidation means the same. And will recognize any gain or loss in the disposal in the group accounts. The parent will also recognize the gain and loss into its individual accounts. Readable or not quite much? This is for the group. This is for the individual. And this is the question which already have got those same figures that we even have worked. Even the same process they have applied in getting those answers done. Is it? Check this out, the inner column calculation. So first case, the simplest of all, we have been able to just finish it by before leaving the course of today. The first most case of this, why I would say this case to be the simplest one, because this case does not have anything further to consider except the highlight of that case was the gain loss calculation. You should know the pro forma of gain loss computation for group financial statements and for individual. But overall, the idea was not to consolidate, since there is a loss of control, and because of the loss of control, you cannot think of consolidating. This way, we will take the most of the time of the next week course in finishing the rest of the 3 cases. But what a fruitful explanation today we have had. And too much of that explanation requires to have a revision. before coming to meet me in the next course. I don't have to say this. You know better by yourself. These things can become a lot of tough if you're not going to pay attention to it in your continuous revisions in everyday life. At least a night before, or even on Saturday, your course is planned in the afternoon. You always can wake up, no matter at 9 or 10 in the morning, and then 1 hour maybe or 30 minutes try to review the board work of the last class week explanation before coming into a course which is being planned to take it at 3 in the afternoon. This obviously will help you. You will find the difference in, if so far you don't do it, try to do it once, because I'm saying it to you. You will see the difference. Even in the live course, you feel more connected. You feel yourself more connected. You feel yourself more connected to the course, since 6 days before, whatever you have done, you can't be keeping it the whole week in your mind. But if before the class, 30 to 40 minutes of a revision, if you can do, it's going to help you even taking a live course. Enough of the explanation we have had. You will expect to come into the next course to continue this topic with me. That is a course of today. I hope all the stuff, the way I had been able to present it, explained it, performed it, you found it to be easier for you to revise later on. I only can say to you, please revise it before coming into the next course, before we will meet. Okay, so that is the course for today. Thanks to all of you for coming and have taken the live session. Continue taking the live sessions, as many as you can. Try to defer any of those commitments that you have over to your live courses of explanations. Even if you got the liberty to watch the recordings, still preference has to be there to follow the live course, strictly based on the timetable that you people have all registered for. So I will see you the next Saturday to continue. Have a good evening. Thank you very much.